part A, critically comment on the CFO's opinion that it is better to rather outsource the production of sauces instead of investing in a new manufacturing plant. Make use of calculations to support your discussion. And then there's 1 mark available for communication skills, and that is awarded for logical arguments. All right, so if you go back to the information provided in the scenario, we did discuss this already at a high level. We said that both of these investment opportunities have a different useful life. So you can't just compare the absolute net present value and say, go for the option with the higher net present value. Instead, we need to calculate an annual equivalent, and we go for the option with the higher annual equivalent. Now, you'll see in the suggested solution as an alternative, you can also calculate replacement chains. So I have included that as an alternative in the solution for you if you prefer that calculation. But you'll remember from our lecture, I use the annual equivalent calculation. It's a little bit easier to understand the logic behind the annual equivalent calculation. So that's why I prefer that calculation. However, you can use replacement chains or annual equivalent. You select the one with the highest replacement chain or the highest annual equivalent, and that is the better alternative. All right, so this is comment, we need to critically comment. So please note this is a discussion question, which we are going to support with calculations. So how are we going to calculate the annual equivalent of each of these options? This is going to be the present value that you input into your financial calculator. So for the new plant, the present value is 7.6 million. N is going to be equal to 8 years for the new plant. And I, remember we are looking at an investment decision over here. And with an investment decision, what do we use as the discount rate when we calculate the net present value? Think back to our lecture on capital investment appraisal. We use the target WACC as the discount rate. So I is going to be equal to 12%. And you are then going to compute the payment because we are trying to calculate an annual equivalent or an annual amount. So compute payment. And you do exactly the same thing for this alternative over here, the alternative to outsource production. This is going to be the present value that you input into your financial calculator. N is going to be 10 years because the contract for outsourcing is for a period of 10 years. I is going to be equal to 12% because with investment appraisal, we use the target WACC as our discount rate when we are calculating the net present value. So I is 12%, and we are trying to calculate an annual equivalent, so you compute payment. All right, so for now, I'm just jumping to the suggested solution to show you guys. Let's first look at the calculation. So you input the present value of each option, you input the useful life of each option as N, I is the target WACC, and you compute the payment. And then you can see there is the alternative over there if you want to calculate replacement chains. There also is an alternative over here where you can use factors to calculate the annual equivalent instead of your financial calculator. But it's much simpler, guys, to just rather use your financial calculator. All right, calculate an annual amount. Now this is comparable because now we have an annual amount. So now it doesn't matter that these projects or these different investments alternatives have different useful lives because we've now calculated an annual amount. And we are going to select the alternative with the higher annual equivalent. So that means the best alternative is going to be the new plant with the higher annual equivalent over there. All right, so let's have a look at the discussion. So the investment opportunities have different useful lives. So it is incorrect for the CFO to base the investment decision on the net present value calculated. Instead, an annual equivalent should be calculated, or a replacement chain should be calculated as an alternative. And the investment with the higher annual equivalent or the higher replacement chain should be selected. So we can see here that would be the new plant that has the higher annual equivalent. It also has the higher replacement chain. So based on the calculations above, it is clear that the CFO is incorrect, as it appears that the new manufacturing plant will be the most profitable investment. Then one extra point that you could have discussed here, guys, because we know whenever we are looking at investment decisions, we don't only make the decision from a financial point of view. So obviously we know if a project has a positive net present value, we should invest because it's going to increase the value of the company. But you should also always consider qualitative factors before making a final decision. Don't just go for the option with a high net present value. You should always consider other qualitative factors. For example, if they do decide to outsource, they will lose control over the quality of the production of sauces. They will also have to share the secret recipe, etc., etc. So those would be some qualitative factors. But you didn't have to discuss the qualitative factors over here. You just had to note that the decision shouldn't just be based on financial factors alone. You should also consider other qualitative factors. All right. So, and this communication skill mark over here, guys, you can award yourself this mark if you have supported your discussion with calculations. You can then give yourself that mark. If you're only focused on calculations or you're only focused on discussion, then you can't give yourself that mark.